and I am going to get started. It is 9 o'clock, and I want to have a conversation about I-bonds. It is so much that is going on in the world right now, so much uncertainty. Our stock portfolios, our investment portfolios are being hit because of all this uncertainty and all this inflation. So I want to talk about how we can invest for the times, how we can earn a little bit more money on our investments rather than just sitting everything in the stock market. And I-bonds is actually an opportunity to do that. Right now, yes, I-bonds are paying 9.62%. So I want to talk about what are these I-bonds and how we can add these to our portfolio and who should be adding these to their portfolio. So if you don't know me, my name is Renee Collins. I am a certified public accountant as well as a certified financial planner. I'm also the founder of a company that's called Retire Ready. Retire Ready is a registered investment advisory firm that provides financial planning and financial literacy, can't talk right now, to businesses as well as to families to help them to save more money, invest smart, and to build wealth. I'm a mom, a business owner, a veteran, and I am an educator of all things money. So today we are going to be talking about I-bonds. What are I-bonds? And if you have any questions, feel free to put the questions in the chat and I can answer your questions as I go. So what are these I-bonds? I-bonds are basically, they are federal bonds. You are providing the government with your money. You're giving them a loan of your money, and in return for the use of your money, they are providing you with interest. And right now, that interest is, like I said, it is at 9.62%. So I-bonds, the I in I-bonds, it stands for inflation. These investments are an opportunity for you to take advantage of inflation, these high historic inflationary times that we are living in. And the nice thing about I-bonds is that because they are issued by our federal government, they are relatively low risk. So think about it. The idea of defaulting is very low because it is our federal government. If our government wants to raise money, what do? They are going to either tax us more or do what they do best, and that is print more money. So these investments, they are relatively low risk. And that's good because you cannot find an investment today that is going to pay you 9.62% and is also low risk. So that's what I-bonds are. They are bonds that are issued by our federal government. They have a 30-year maturity. However, you don't have to leave the bonds with the federal government for 30 years. You can take them out after 12 months, and I'm going to talk a little bit more about that. So what are the characteristics of these bonds? There is an interest component, and it has two components that are attached to it. One is a fixed component. Once you purchase these bonds, that fixed component, it doesn't change. It remains the same. The other component is a variable component. Now that variable component, it is actually tied to the inflation rate. And the way we measure inflation is through the consumer price index. And what we know right now is that inflation is really high. So that is the beauty of these bonds, is that it's tied to inflation. So with inflation being at, I think it's at 9.1% is what it came in for the month of June, these bonds right now, they're paying out 9.62%. Now that rate, it changes semi-annual. So, and it's actually is compounded semi-annual. So what that means is that 9.62%, you're actually going to get 4.81%. That is what's going to be accrue to your bond because it's paid out on a semi-annual basis. Now, these bonds, the interest is going to reset in November. November, the federal government will take a look at the consumer price index to see if inflation is still pretty high. If it is, then it's likely that this rate could stay the same or it could go down. And just assume, let's say it goes down to maybe 8%. So if it goes down to 8%, then you are going to earn 4% over the next 4 months on your money. So you've already earned 4.81% on your money, and then you would earn 4% on your money as well. That is a total of what, 8.8%? So you're still getting a really decent rate of return on your money. So how much do you need to invest? You can invest with as little as $25 with these IBONDs, all the way up to a maximum of $10,000. And you can actually get around the $10,000 if you have a trust. So if you have a trust, you can actually purchase $10,000 as an individual, and then you can purchase another $10,000 in these IBONDs in a trust. And if you have a business, well, you can put another $10,000 in your business. So there's a way to get around that $10,000 limit, but it's important to understand that you can start with as little as you want. And unlike the stock market where your money can go down depending on what's happening in the economy, there's no negative return on IBONDs. Now remember, they're tied to the consumer price index, which is a measurement of inflation. So if over time the rate goes down or inflation goes down, then your principal that you've accrued is still in place. Your principal is protected. So there's no negative rate return. At the worst, you won't earn any money if inflation is really low, since remember, it has two components. It has a fixed component, which right now is zero. That's the zero interest rate. And then you also have the variable component, which is tied to inflation. So right now, again, inflation is high. And if it continues to stay this way, which we hope that it does not, and the Federal Reserve Board is fighting against inflation by increasing interest rates. So hopefully it doesn't stay as high as it is now, but economists are saying that they do think that we're going to be in these high inflationary times for the next 18 months or so. And then, as I mentioned before, these bonds, they have a 30-year maturity, but it doesn't mean you have to leave your money in there for 30 years. Let's say after 18 months or so, inflation has gotten under control and interest rates in a savings account are paying you better than what you can get on an I-bond. You can take your money out of the I-bond and you can put it into a savings account. So you can do that, and you don't even have to take out all of your money. You can take out a portion of your money, put it into the savings, and you can leave a portion in the I-bond. So that's important to note as well. Now, what I want to talk about are some of the restrictions. So who is this I-bond for? These I-bonds are for people who really have some money sitting on the side. You have your emergency fund in place, hopefully anywhere from 3 months to 6 months. And because there's all this talk about recessions, you may even want to have a little bit more savings on the side, maybe even 9 months of emergency fund on the side. And also for people who are already contributing to their 401k. Because remember, investing is about having balance. So you want to have some money in the market, even though I know it's hard because the stock market has been going down. But you want to have balance, because where we are right now with regards to the economy, it's a cycle. And in order for us to take advantage of this cycle of the potential upside of the market, we have to have some balance. So you want to have some money in the stock market, in your 401k, but having access to the I-bonds gives you a little balance. So again, this is for someone who has their emergency fund in place. They also have monies going into their 401k, and maybe you have some money in your savings account that you're not going to need for the next 12 months. Because once you make an investment in these I-bonds, you can't get access to them for the next 12 months. So you won't have access to this money for 12 months. And the interest on these bonds, it is deferred. So the government is not going to be sending you a check for these bonds. That interest, it actually gets accrued to the bonds, and you don't actually have access to that interest until you sell the bond or you redeem the bond. Now, as far as taxes, how are taxes impacted, or how do they affect your taxes? From a state standpoint, the state does not tax government bonds. So the interest on these bonds is not going to be taxed. And you're not going to pay taxes on these with the federal government until you actually redeem the bonds. So that is a plus. So it's tax deferred, similar to a 401k. You don't pay any taxes on your earnings until you actually take a distribution from your 401k. And I already talked about the liquidity issues. Again, if you're investing in these I-bonds, you're investing money that you don't need for the near future. Now, what happens after that 12-month period? If you say 18 months later, you want to take some money out. The monies that you take out, what's going to happen is that you are going to be penalized for 3 months interest, for 3 months. So it operates similar to a CD in that fashion. But again, if you're earning 8%, 9% on your money, 3 months interest, that's not a bad deal. And then that only stays in place provided you have these bonds for less than 5 years. So let me say that one more time. You cannot access these bonds for 12 months. So that's a liquidity issue. And you want to put monies in the I-bond that you don't necessarily need for the next 12 months. And if you cash them in before 5 years, and you can do that, then you're going to lose 3 months interest. Okay, so I just want to make sure that everyone understands that. And again, it's still a pretty good deal because you can't get anywhere near 8, 9% on an investment that is relatively low risk anywhere in the market today. So how do you buy these bonds? You can't go to a broker and purchase these bonds. They're not traded on the market in the same way that stocks are or mutual funds. You have to buy them directly from our federal government. And you do that through treasurydirect.gov. So you can go to the website, and then I took a snapshot of the website so that you can make sure that you're at the right website. And the accounts are actually pretty easy to set up. I set up one just to go through it and see how does this work. I thought it was pretty easy to set up. They have a guided tour. So you can go through, they tell you everything that you need to actually set up the account. You need your tax ID number, your address of record, and your savings account that you want the government to take the money from. So you will need that information as well, an email address, and then of course a secure browser, which I believe most of us have anyway. Now, one of the things that I would say, based on my conversations with other people who have tried to set up these accounts, I didn't have any problem setting up the account, but you want to make sure that you keep your account number as well as your password, because again, this is our federal government. There's a lot of bureaucracy. If you lose that information, you may pay havoc trying to get the information back so you can get into your account. So keep your password, and then make sure you keep your account number as well. And so they're going to send you the account number to your email address. I would recommend that you either print it out or, take a picture of it or whatever, but put it in a safe place so that you can log into your account later. So that is basically it for IBONDS. And if anyone has any questions, I am definitely open to answering any questions about IBONDS. Again, it's a relatively low risk, really risk-free, because it is the federal government. And the federal government's, more than likely not going to default on these bonds because they always have the ability to tax us more or to print more money. So good investment to take a look at. It's a good way to balance out your portfolio. Just remember that if you are investing in these bonds, you want to make sure that you have your emergency fund in place, that you are investing in your 401k, and that you have some cash sitting on the side that you don't mind allowing to give to the government for the next 12 months or so. Are there any questions? I don't see any questions coming in. See, I don't see any questions coming in, so I'm going to go ahead and sign off. And before I sign off, though, I just want to give my contact information. So if anyone is interested in contacting me about their investments, if you have some concerns, you want to talk about retiring, in the near future, or just accumulating retirement funds, here's my contact information. I am going to be going live over the course of the next week or so, just to help to alleviate some of the concerns with regards to what is going on in the economy, because I've been talking to people via conversations, with doing presentations like this, and people emailing me and calling me, and people have valid concerns about what is going on in the market. So I'm going to be going live and talking about a recession, because that's what economists are talking about now, whether or not we're in a recession or we are going through a recession. So I am going to talk about what do we do? How can we plan for a recession? So check me out next week. Come back to our page. I will be announcing it on my personal Facebook page as well as on the Retire Ready To page, so that we can start preparing ourselves for whatever is to come in the future. And then I'm also opening up my course. It is called Financial Freedom Roadmap course, and it's just really to help families and business owners to start establishing a foundation for their money so they can save, invest, and